Now, this task is about interpreting financial statements using profitability ratios. Um, Identify two primary users of final accounts. So you would know who uses the final accounts. We have discussed this in the class. Two primary users, they are saying, okay? Two primary users. Who are the two primary users? All of them are users, but who are the primary users of final accounts? So it will be investors, government. Let us see the answer for this. Yeah, investors and lenders, because investors want to invest in the business and lenders would want to see your final accounts, whether you are paying on time, how many as liabilities you have before they. So these are not the direct users. Government is not a direct user. Customers are not bothered about all your figures. Employees also not bothered about all your figures. But the other primary users for each and everything is the investors, because they want to see how well you have invested and how well are your returns, and lenders because they want to decide whether they want to lend you the amount or not. So they are the ones. Then the next one we are going to see is which are the accounting principles being described in each of the following scenarios. Sales revenue is recognized when goods and services have been supplied. Costs are incurred when goods and services have been received. So these are the different accounting principles. So you record the sales in the year it is sold, and you record an expenditure in the year it is due. It is incurred, not when it is paid. So this particular concept is called as accrual principle. Financial statements are produced using the assumption that an entity will remain in business for the foreseeable future. So you assume that the business will continue to exist, which is called as a going concern. Transactions and valuation methods are treated the same way from year to year. That is called as consistency. Assets or income should never be overstated, and liabilities or expenses should never be understated. So it is like a rule. So you should do the right things. So when it says you should do the right things, it is basically prudence. So you should be prudent, you should be careful. That is the word for prudence. Okay. So you could have a materiality in this as well. So materiality is not big enough to consider it as an expenditure, or small enough, uh, or big enough to treat it like an income. So it is the policy of the company to treat it the way they treat. So that is a materiality principle. Accrual is you treat the expenses and income the year they are incurred rather than the year you receive. That is an accrual principle. Going concern is continue to exist in the future. Consistency is consistent across the years. If you have to change something like a depreciation method, you can't change to have. So if you are doing computers at a certain on straight line method, you have to do all computers on straight line method. You can have different depreciation methods for different assets, category of assets. Like computers should be one category, vehicles should be another category. So you could have vehicles for diminishing balance method, you could have others one at straight line method, but then you can't have computer A at straight line, computer B at something else or diminishing balance. So you can't have that. So the same category class of asset should be at the same method. So that is what is this thing. And prudence is being prudent, being careful, being correct, what is right and what is wrong, being ethical. Identify whether each of the following statements about profitability ratios are true or false. The analysis of financial statements using ratios provides useful information when compared with previous performance or industry averages. So the analysis of using ratios provides useful information when compared with previous performance, or yes, that is true. So true or false is best if I just look at the answer and tell you, explain. Yeah, so the analysis of, so it tells us either we can compare with the past years, or we can compare with the industry average, or we can compare with similar organizations. All your gross profit margin, your capital employed, return on all that can be compared. A business will never use financial ratios to assess its performance. Never. Again, use the word never is a catchy word. So business will never use financial ratios. No, they will use occasionally to assess its performance. So that is a false. Ratios based on historical data can always, again, the word always is the catchy word. So always predict the performance. No, always is not right. Sometimes, or most likelihood. But if they say use the word always, never, all, none, so you should always be very careful. Negative words should always be like, take care about those. definitive words. So that is also a false. Now we'll go to the next one. The statement of profit or loss of a business shows the following figures. They have given us the sales revenue, they have given us the gross profit, they have given us the profit or loss. They have given us the current liabilities, non-current liabilities, and the capital. Return on capital employed. So you have to find out the formula for return on capital employed. So return on capital employed is profit divided by, 1 minute, let me calculate it and then come to you, okay? Just give me 1 second. It's going to be 59.30. So what formula have they used? Let us see here now. Okay. So what you have to do is return on capital employed is equal to profit divided by uh, NCL, which is the non-current liabilities, plus capital. Don't take current liabilities. Okay. Take the profit divided by these two. Multiplied by 100 for the percentage. That should give you 59.30. Now they are asking you calculate the net profit margin. So if I go back to the question, net profit margin. So you do 79,350 divided by sales, 429,120 multiplied by 100. That gives me 18.49. If they asked us to round it up, have they answer to 2 decimal places. Okay. So because they have not said round it to decimal places, on the calculator, I'm getting 18.49. So leave it at 18.49. If they say round it to the next number, then you do 0.5. But then they have not said, just they have said answer to 2 decimal places. So just leave it at 18.49. Then the next one is the selling expenses to revenue percentage. So selling expenses divided by revenue shows what when compared to the previous year. So, oh, they're asking us to do it. Okay. The business had a selling expense revenue percentage of 13.2. This year it was 15.6. So what does that mean? Selling expenses have gone up, it means. Okay. Because the selling expenses, so what has happened is the expenses to revenue has gone up. It means you have spent more. So it means it has gone down. So the percentage shows a increase, a deterioration when compared to the previous year's figure. What deterioration? Basically the profit figure. Okay, that is what it means. Selling expenses are to revenue percentage. Yeah, it is a deterioration. So what it means is they have spent more. So it is not good. So it is a deterioration. Identify what effect, if any, of the following scenarios may have on the ratios stated. Each scenario is independent. A business has managed to negotiate a lower price with a main supplier of inventory. This has not affected the quality of the goods. So we are assuming that they are only negotiating a lower price. The quality is intact. The quality is good. So what happens to my return on capital employed? So if I'm spending less amount on inventory, it means my cost of goods sold is going to be less. If the cost of goods sold is going to be less, it means my gross profit is going to be more and my profit is going to be more. If the profit is going to be more, my return would be more as well. That is why there is a return on capital employed has gone up. Okay. Because how did I link it? See how I thought in my mind. So how did I do mind map? How did I think about it? So when they have negotiated a lower price means my expenses have gone down. It means my cost of goods sold has gone down. It means my gross profit has gone up. My net profit has gone up. If my net profit has gone up, return on capital employed has gone up. Okay, that is what is your increase. Net profit percentage will have gone up as well because of that. Like we just discussed the whole thing, that has also gone up. Oh, it is a different one. Sorry. Next one. Sorry. The wage rates of admin staff have risen in line with others in the industry. The number of staff employed and the skill levels have not changed. So the wage rates of admin staff have gone up. Okay. So it means now gross profit, guys. What does gross profit mean? Gross profit is sales minus cost of goods sold. Okay. It does not, so gross profit it at that stage. So if the admin staff has gone up, it should not make any difference to my gross profit. So it should not make any difference to the gross profit because it starts like this. So we do sales minus COGS. What is COGS? Purchases plus, opening inventory plus purchases. Opening inventory plus purchases minus closing inventory. Okay. Is your cost of goods sold, and sales minus cost of goods sold is gross profit. So the admin staff wages do not come at this stage. That is why there is a no change. Whereas after the gross profit figure, we include the wages. So here, after the gross profit, we take into account all other expenses. So here I am going to take the wages, salaries, wages, everything. So if at that stage, if the admin staff wages have gone up, my profit is going to go down at that stage, net profit percentage. So that is going to decrease. Let us look at the next one now. Now, about preparing accounting records from incomplete information for 12 marks. I don't know if you could select questions which are easier and finish them first. I'm not very sure if you're confident with certain things. See, these last, maybe this second last question, maybe some people are confident with the profitability ones. So if you know the ratio, you can do that first, maybe. If some people are good at partnerships, finish those first, maybe. So you can then go in your, I mean, some people don't like it, some people just like to follow, but don't waste your time on one particular question. This task is about preparing accounting records from incomplete information. Ian runs a business as a sole trader. He ran a report from the accounting software system. The report stated that the closing balance of a product was 368 units, valued at £1 per unit. An inventory count revealed that the business held 378 units, valued at £1 per unit. Okay, what's the question? Ian runs a business. The report stated that the closing balance of a product was 368 units, valued at 1. However, an inventory count revealed that it is 378 units. Okay, fine. So on my closing balance, it is showing me 368, but actually when they counted, it is showing only it is showing more, in fact, 378. So what could, so if the actual number is more, theft of inventory, no, that can't explain the difference. A purchase credit note had been entered twice into the, again, guys, if you think these are just too much to think, whatever you can do them quickly, others you can leave. I mean, that should not be your first choice, but you can. So in this particular question, the actual numbers are more, the accounting record is shorter. So theft is surely not the reason. Because physically they are more in number. So theft can't explain the difference. A purchase credit note has been entered twice into the accounting system. That is a possibility because it's a credit note and they've entered twice. So if they've entered twice, it means the balance may be showing less because of that. So that can explain the difference. A box of the product had been omitted from the inventory count. No, if they had omitted, then the inventory count would have been lesser, not more. So that's not the reason. A box of unused products were returned to the supplier, but this had not been recorded in the accounting system. So a box of unused products were returned to the supplier, but this had, so if they were returned, my inventory count would not have been more, isn't it? It would have been less. So that also cannot explain the difference. I'm glad they're asking only these kind of questions. I thought they will ask you very big questions on this topic. Uh, if the closing inventory reported was too low, this would lead. So I am seeing, guys, this is all about knowledge. What affects what? What affects if an expense is more? What happens to the profit? If an income is more, what happens to the profit? If liability is more, what happens to the capital? If an asset is more, what happens to the accounting equation? I can see only those kind of questions, more analytical questions than your um, question styles. The first four questions, three questions were proper how to do. The last three questions are analytical questions. And this is what is the future of data analysis and data management. That is why they are making you do these kind of questions. Okay. So if the closing inventory reported was too low, this would lead to the gross profit being less or more. And I'm sure that is a thing overstated, understated, and the current assets being overstated or understated. So if the closing inventory was low, surely the current assets are understated. That is no doubt about it. What happens to the gross profit? So you take away the closing inventory from your cost of goods sold. So if it was too low, then what happens to your profit? So let's look at that. So understated. Again, why? Because I just wrote it here, isn't it? Where have I written that? Here, see here. So here, sales minus COGS. So what is COGS? Opening inventory plus purchases minus closing inventory. If this minus figure was a less number, then what happens to your, is that what they're asking us? Profit figure? Yeah. So what will happen to your gross profit? Because you are subtracting a smaller number, surely your gross profit is understated. Okay, so your current assets and because your gross profit, sorry, your assets are low, it means you are understating your current assets as well. Calculate the sales excluding VAT. Anton runs a business as a sole trader. All products are sold using a gross profit margin of 30%. The business is registered for VAT and all sales and purchases are standard rated. Sales during the year where, guys, it is including VAT, okay, where 76,080, purchases including excluding VAT, where 48,390, inventory as at first, again, how many marks is this? Just 1 mark. Okay. Calculate the sales excluding VAT for the year ended 30th June. All right. Excluding VAT. So they have given us including VAT. So 76,080. Okay. Oh, the profit margin was 30. So they're not asked us the profit anyway. Yes, it will be 60, I think, isn't it? 63,400. Just give me 1 second. Yes. Yeah. All you have to do is you take away the VAT from this. Okay. So you divide it by 6 and find the VAT and then just take it away. That will give you the sales excluding VAT. Purchases, next question. Calculate the cost of sales for the year ended. Now, how would you find out cost of sales? Purchases, opening inventory plus purchases minus closing inventory. Okay, that is going to give you the cost of sales. How do we do that now? All products are sold. What is there another question? Closing inventory. Okay, they're asking us to calculate the closing inventory. Fine. Let us do this question. How much more time is there on my battery? I have to go and get my battery charger. All right, just give me 1 second, guys. Okay, I'm just calculating something. So if it is 30%, opening inventory, purchases. minus. So they have not given us the closing inventory, guys. So you have to use the profit figure. You have to use the margin figure to find the closing inventory. Okay. So it is going to be 19,020. It's 463. Let me see if I am right. Cost of sales. Sales even. 1 second, guys. Which is the margin 70. Use that proportion method or the butterfly method, guys, to find out the cost. I'm just doing it and then I will help you with the cost. So it is 63,400. 400. Yeah, 44,380. Okay, so this was how we learned the other day, guys. Okay, so there is a, so if you want to know the cost of sales, you need to know, so what is cost of sales? Same as cost of goods sold. So is equal to opening inventory plus purchases minus closing inventory. Okay. So this is what you need to know. So cost of sales. So the other way to do cost of sales is, but I don't know closing inventory either. So I can't have two unknowns in this question. So what I have to do here is I know that there is a margin here. So they have given me the gross profit margin. So, and I have calculated the sales figure here. So what I would do is I will use that method to just do this now. Okay. So when the sales margin is given, sales is 100. Okay, so sales 100. Okay, and cost would be 30. Sorry, cost would be 70, or you can say profit would be. You can write whatever way you want, guys. Okay, I don't know how have I explained in the class. Have I said cost minus profit is equal to sales minus profit is equal to cost, or the other way around? Whichever is you put this equation the way you want. The only thing is you have to remember is if it is a margin, you start as sales as 100% and your profit margin was 30%. So your cost is going to be a 30%. Okay. So I can put it like this again if you want. So sales is a 100. So your cost. So I know the profit figure because it's a margin. It's going to be 30. So your cost is going to be 70. So if 100 corresponds to, we just found this answer, 63,400. Okay. What does your cost correspond to? Because we don't want profit figure yet. So you just do again cross multiply or the butterfly method that was explained the other day. So that makes it 63,400 multiplied by 70 divided by 100, basically 70%. Okay. So That makes it 44,380. Okay. So if you say if sales is 100, because it's a margin, it is included in this. So you minus that 30, your cost becomes 70. If sales is 100, which corresponds to 63,400, so cost would be how much? So you cross multiply 63,400 times 70 divided by 100, or basically you just find out the 70% of 63,400, which comes to 44,380. Now you have to substitute the values in the formula to get the closing inventory. So I now know the cost of sales. I know the opening inventory. I know the purchases. Just find out the closing inventory. That will give you this 9,060. So if I were to write cost of sales, so my cost of sales was 44,380. So 44,380 is the cost of sales is equal to purchases, which was 48,390. What was opening inventory? What was opening inventory? Opening inventory was 5,050. So 5,050 plus purchases, which is 48,390, minus closing inventory. Okay. So by following the equation maths rules, I find out the closing inventory and then just reverse all the other operations. So 5,050 plus 48,390 minus 44,380 will give me 9,060. Just follow, reverse the operations, because closing inventory, you'll have to bring it on the other side of this equation. Okay. Or so I would get 5,050 plus 48,390 minus 44,380. That should give me 9,060. The business buys dolls for 40 and sells them for 48. The business is not registered. Business has a markup or a margin they are asking. So again, you can do the same thing. So if they buy the doll for 40 and they sell them for 48, so surely 8. So if it is 20%, so what I did was, guys, find the difference. The profit is 8 pounds. So if I do 8 divided by 100, 8 divided by the 8 divided by purchase price. So 8 divided by the purchase price, you get a markup. So it is a markup of 20% because it is not included in that. So if you do difference between these two, divided by the purchase price, you will get 20%. So it means it is a markup. You're calculating on, so also you can think like this. On 40, calculate 20%. So if it is like that, it means it is a markup. So it is on the cost. If it was margin, then it would have been included in that. But because it is a markup, you calculate 20% on the 40, you will get 48. So it means it is a markup. Okay, I think we have done, is it? Yes, we have done. We have finished. Stop sharing. Stop recording.